Hello, this is Corner Invest. So is the stock market bottom truly in yet? So in today's video, we'll be covering a few things. So number one, we'll be covering whether or not the stock market has truly bottomed, great stocks that have fallen massively this year, as well as your hyperscalers, your Amazon, Microsoft, and Google as well. So this is the stock market heat map over here. As you can see, all your different other Mac 7 companies, they're down massively year to date. So Microsoft, Google, Apple, Nvidia, Amazon, they're all almost in a bear market already. In fact, a lot of them are already in a bear market. And then you have Tesla down nearly 40%. Meta at one point was up around 20-30% or so, and now is down 14% year to date. So this is the stock market heat map. It's clearly not a very good year. A lot of all your different tech stocks, your financial stocks, they're all in dip rate. And that is why we're seeing the stock market down around 10% year to date. So this is the tariff update so far. So Trump has imposed 245% tariffs on China, and EU is prepared to impose sanctions on the US if the deals fall through. And EU is already punishing all the different big tech companies in the US. So for example, they have sued Google for having a monopolistic practice in the EU. So this is EU's way of hitting back at the Americans. They are hitting back at the Americans by hurting all the different big tech companies. And if the deals don't come, then you will see a lot more of that coming as well. So this is how I view tariffs. Tariffs on China above 100% are basically just numbers. Anything above 100% are just arbitrary because all your different trade, they will stop as soon as it reaches above 100% because above 100% it is impossible for you to trade between these two countries already. And I think the markets are pricing in a deal between US and China, and they're not fully pricing in sort of like the true impacts of tariffs. So if you're to just look at the tariff rate by the US over the past few years or so, over the past 20 years, 30 years or so, we're currently at one of the highest levels in terms of the tariff rates, even if it's just 10%. And the markets are not pricing in the fact that the deals may not come. And if the deals don't come, then we will see a lot more downside in this market than we experience today. But this is not financial advice. I feel market valuations make sense right now. Maybe it's time for you to buy into the market slowly as opportunity comes. So the S&P 500 right now is trading at around 24 times earnings, and the average over the past 10 years is also around 24 times earnings. And now we're trading at around 18 to 19 times forward earnings, which was where we bottomed in 2022 as well. So maybe it's time for you to look ahead into this market right now, especially when valuations make a lot more sense than it was maybe 3 to 4 months ago. So this is what Warren Buffett did during the last tariff war. So in the last tariff war in 2018, US had a tariff war with China, but despite this, Warren Buffett, he bought a 7% stake in Apple over here. So Apple has a lot of its operations in China. They have a lot of sales in China as well. But despite this, Warren Buffett, he bought around 7% of his position, 7% of his entire portfolio in Apple in this year. So this is how I view tariffs as well. If the tariff provides reasonable valuations for all these different companies, then it wouldn't be a bad time for you to buy into it. Warren Buffett can do it. So I think most of us won't go wrong doing it as well. And I suspect he bought a lot more shares in the last quarter because valuations have come down, but it's time for him to add. So this is the S&P 500. The S&P 500 is now down around 14% from the highs. So we're not in a bear market yet, but at one point we were close to a bear market. So we nearly closed that bear market territory, and that day was when Trump, he basically announced that there'll be a 90-day delay on all the different tariffs on all these different countries. So there's clearly sort of like a Trump put over there, and that is what all market participants believe. And if you're to just look at all the stock market crashes since 1950, every single one of them, almost all of them, had a very long duration. And if you were to go into a true bear market this year as well, then we will see a lot of bear market rallies where the stock market goes up 10% and then goes down another 20-30% or so. So be prepared for that. This one might be a lot longer than expected. No one knows. So let's see where it goes. So is the bottom in yet? So this is the NAAIM exposure, the NAIM exposure. So 100% is when they are 100% long stocks, and then 0% is when they have no exposure to US stocks as well. So over here, the exposure index is at around 35. So this one over here, it is not a very low point yet, but you can clearly see that all these different points over here in 2020, for example, and in 2022 as well, when we were below 20, that was when the market truly bottomed. And yeah, we're approaching 20 soon. So if we approach 20 soon, then it is likely that the stock market sentiment has gone extremely bad, and it wouldn't be a bad time for you to buy into the markets. So this is the bearish outlook. So over here, we've never had consecutive weeks of this bear sentiments over here, and it has been 8 weeks since we had bear sentiments already. So this is a record in terms of history, and over the past few years or so, if you were to look at every single time where this bearish sentiment peaked, it marked the bottom. So again, this is another indicator that could mark the bottom. No one knows, but let's see how it plays out. So this is the put to call ratio as well. Put to call ratio, it is at one of the lowest points as well. In COVID, we had a put to call ratio at extremely low, and then that marked the bottom as well. 2022 as well. 2022 wasn't as low as it is today, and in current market situations, we are only slightly higher than it was back in COVID. So again, another bottom indicator. But again, trying to perfectly time the bottom is extremely difficult. Instead, catching the knife might be the most predictable one. So if you're looking to buy now in this current market situation, then buying into quality businesses is normally the approach that you want to take. Don't buy junk companies, because junk companies, if a recession actually comes, then all these junk companies they'll be decimated in an economic downturn, and that is what you don't want to find yourself into. So buy high quality names and just catch the knife as it comes down. That is what I'm going to do. That's what I'm planning to do. And let's see how this plays out in a few years' time. These high quality compounding machines will definitely yield me much higher returns than if I were to just sit out and then just wait and panic and like do nothing. Anyways, so this is what I'm planning to do. So next portion over here, great stocks that have fallen. Two companies over here. One of it is Novo Nordisk. The other one is ASML. So this is Novo Nordisk over here. As you can see, the revenue has been exponentially increasing over the past few years. It's been picking up pace over the past 10 years or so, past 5 years or so. And then same thing for the earnings as well. The earnings is picking up and then it's going upwards in an exponential way. So this is clearly not a dying company. It doesn't look like it's a dying company, and yet the markets are selling off like as though this company is dying and this company is not able to sell their products. So this is the stock. The stock is down around 61% from its highs. And this is a company that is a leader in the weight loss drug industry. So they created the first drug. The first drug that came out was Ozempic. And they have the first mover advantage because everyone that talks about weight loss drug, the first name that comes to their mind is Ozempic first. So for the weight loss drug industry, it is projected to grow around 15% till 2030. And Novo Nordisk, they now have around a 30% market share. So if Novo Nordisk can hold a 30% market share and the entire market can grow at around 15% or so, then Novo Nordisk will definitely have outsized returns at this point. But for me, I'm not looking to buy into Novo Nordisk simply because I don't understand the industry enough. I don't understand the stock enough. I don't understand the patterns and all the complications for that. And unless it drops to around $46, where it is basically a no-brainer already, then I don't think I'll be adding into this stock. Hopefully it drops to $46 so that I have an extreme high margin of safety for me to add into this stock. But let's see how it goes. Next stock is ASML. So ASML over here, they create these machines over here. This giant machine is what ASML does. And for ASML over here, this company is just a monopoly. They operate in this patterning section over here, which is one of the most important sections in your chip making process over here. So patterning section, it holds the highest dollar amount as well, around 31 billion. And ASML is the only company in this entire chain over here that holds a monopoly. So if you're to look at, for example, AMAT, Applied Material has around a 40% market share, 30% market share. They are jack of all trades, but master of none. But for ASML over here, it is the only company in this entire supply chain that has a true monopoly. And that's why I think ASML is one of those companies that is extremely high quality and extremely reasonable right now. So for this company over here, this is the PE ratio of ASML. So after this earnings, the price to earnings ratio will be at around 25 times. So this is the line for their price to earnings ratio. And as you can see, the only time they went to this point over the past 5 to 10 years or so was in 2018 when we had the tariff war over here. So when we had a tariff war over here, the price to earnings ratio went down to around 20 times. But after that point, it has never traded at this valuation ever again. In fact, in the 2022 bear market, at this point over here, it was trading at around 26 to 27 times earnings. And now it's trading at a valuation that is lower than that price. I do think that ASML is a high quality business. It deserves around 30 times earnings. But yeah, markets are irrational in the short run. Let's see how this stock plays out in around 5-10 years or so. Next portion, let's talk about Google, Amazon, and Microsoft as well. So there was this comment that was placed by someone. He said, just found your channel. Would love to hear your thesis on why Microsoft is the most durable business in the world for the foreseeable future, given they rely highly on cloud segment, which faces heavy competition from Amazon. Their gaming and hardware is declining, and they have the AI and Microsoft 365, but there hasn't been a true value add to people's lives today. So this is what I replied him with. So cloud segment with Amazon is more of an oligopoly, with GCP, AWS, and Azure all taking part a significant portion of the market. Many companies operate on a multi-cloud service, and there's still about 20% of the US market which have not migrated to cloud yet. So when the cloud suite is entirely built out, then we'll see companies like AWS, Azure, GCP exercising their true pricing power, and that is when the true returns will come. So other companies outside of these three companies simply don't have the cash to do so. So you can't have a Salesforce, you can't have a Alibaba spending upwards of 60, $70 billion every single year on AI infrastructure to build out all the different data centers to support these cloud services, because they simply don't have the money for that. And so that is the moat for these three companies over here. They have an extremely high barriers to entry, and although it is capex heavy right now, this could be a moat for all these different companies over here. So for Microsoft 365 and AI over here, there is no true way of basically measuring the value add that they have on people's life right now. So the only thing that AI has contributed to our life right now is agentic AI as well as Gen AI, but we haven't really seen a significant impact that it has on our daily lives right now. That is true, but if you were to just look at the numbers itself, so AWS, Amazon, Microsoft, as well as Google, look at the ROIC metric. The ROIC metric is the one that will show you whether or not there is returns on their capex. And so far, all the ROIC has been either maintaining or increasing over time. And as long as this ROIC metric stays, then I don't think there's a problem with all the different hyperscalers having high capex. So if you're to just look at the Netflix 10K over here, this is Netflix 10K. They have highlighted that AWS is operational and basically important for their business. So you have Amazon over here with Amazon Prime and Netflix with their own streaming service. And Netflix is saying that Amazon's AWS is so important to their business that if AWS makes an update or goes wrong, then Netflix earnings, Netflix business will be hurt as well. So this clearly shows how important your cloud services are to all your different other big tech companies, all your different companies in the US. And I don't expect the cloud business to slow down in the next few years or so unless we have overcapacity. At that point, you could see earnings dropping. So this is why I own these three companies. So frankly, I don't know who will win. I don't know who out of these three companies will win. But I believe that your distributors of AI will be the winners in this game. So distributors win, not creators. So you have NVIDIA over here, which is the creator of your AI chips, whereas you have your distributors, which is your Google, Amazon, as well as Microsoft, which is able to distribute all your different AI infrastructure and use it to improve the efficiency of the business. I view NVIDIA as something similar to Cisco. So Cisco back in the day, what they did was they built a lot of different communication services and infrastructure, but no one had the money to go and use them. No one used them. They just built and built and built non-stop without the demand for them. And similarly, NVIDIA is producing a lot of chips, and maybe all these chips could be commoditized next time, just like all your different communication services and all your LAN cables back then. And that is when you will see companies like NVIDIA falling. But I don't believe that your three hyperscalers will experience that because they have the biggest distribution network in this entire world. Google has Google Search, Amazon has the Amazon retail platform, Microsoft has Microsoft 365, where every single corporate industry business owns and uses them. So again, I don't know who out of these three will win the most, and that's why I'm owning all three. I believe that the cloud hyperscalers will win in this game, and let's see how this goes in the next few years or so. So this is when I'll be adding all this stock. So I want to make Amazon, Microsoft, Google 10% of my portfolio each. And this is when I'll be adding into these positions again. So Amazon I'll add at around $160, Microsoft at around $320, and Google at around $130. Google is quite a substantial position in my portfolio already. I still view this company as extremely undervalued. The price target or the fair value that I have for Google is around $190 to $200. Let's see if this company gets there in the next few years and invest safe.